Chapter 3, Gross Income Inclusions. So the income tax concept of what's considered income basically comes from what the accounting concept of income is. And that is that income is usually measured when it is realized. Values are measurable when there is a transaction, so that means there's a sales price and the basis can be determined during a completed transaction. So obviously that's the accounting concept of income. And here it is in flowchart form. What we're looking for is realization of income, and that happens when there's a transaction with a second party and or severance in economic interest in the property. So basically there's a transaction and ownership essentially changes hands, and that causes income to be earned. So that's the accounting definition of income. Now, the tax concept of income is a little bit different, but it has similar concepts here. So for the tax concept of income, three things have to be true or exist. So you have to have an economic benefit, and this in and of itself is not limited to cash payments. So we're not saying cash has to change hands. You have to receive an increase in cash or spending ability. Basically, any type of economic benefit that you receive is going to be considered income. This basically comes from the idea, or is the definition serves to police the concept of, okay, I worked at this job, and instead of you paying me, I'm going to have you directly pay my creditor. That way I'm paying off whatever debt that I have, but at the same time, since the cash never went into my hand, I'm not going to pay tax on it. So obviously, defining this as economic benefit instead of as actual reception of cash or the ability to spend cash prevents that from happening. So then, second step, you have to have realization, which just means for tax purposes that the earnings process is complete. But there are a few, like most things with tax, there are a few exceptions to that. So there are a few times when the taxpayer is taxed even though the earnings process is not totally complete. So obviously we will address those as we come to them. And then finally, there has to be a recognition of income. So under tax law, there are certain exceptions that are provided where even though these first two legs or steps in the process of recognizing income or of inclusion of income have been met, there's specific exceptions written in, codified, or through case law written into the tax law that allow you not to recognize that income. So some examples of that would be there's various types of real estate exchanges that allow you to not recognize income. Also, when we get into corporate tax, you'll see some corporate reorganizations that don't require you to recognize income. And then at the individual level, you've got various types of scholarships that are not recognized as income even though they meet the first two steps here, and then stuff that's specifically outlined as not being recognized as income, such as interest from municipal or state bonds, and this is generally referred to as tax-exempt interest, or these bonds are tax-exempt because there is this exception codified where you don't have to recognize that as income. Okay, so there are a couple of reasons why the income tax definition of income are different than even the accounting definition of income. But the main two reasons are obviously from the standpoint of the IRS. They want to make the administration of income tax policies as, I don't want to say simple because I never really want to include the word simple in dealing with tax, but the IRS does want to make the administration of the tax code as convenient as possible for themselves And to some extent, the policy dictates that you want to make that convenient for the taxpayer as well. Also, there's this concept of wherewithal to pay, and that basically means from a policy standpoint, we don't want to tax someone on income or recognize something as income that doesn't allow the taxpayer to pay the tax on that income. So we don't want to say, hey, you earned all this income, but in actuality, there's really no liquid money there that the taxpayer can use to pay the taxes that we've just said that they have to pay. Okay, so those are the two main policy reasons for adopting these definitions of income. So when we talk about income, Section 61 of the Code defines income as from whatever source derived, and basically, we've talked about this a little bit before, but you basically want to say anything that could be considered income is income unless there is an explicitly stated exclusion or exception that says that it's not income. Okay, so everything's income unless stated otherwise, basically. So again, here's just a small chart of some items that are specifically listed as gross income items. Again, just because it's not listed here definitely does not mean that it is not considered income. And here again, we just have a representation of the first page of the 1040 form. And it just shows some various examples of items considered income. For instance, on line 7, you can see wages, salaries, tips, etc. But obviously that is not an exclusive list, and it lists some other types of income there. And then there's just a catch-all for other income as well. So assignment of income is basically the idea of I'm going to avoid taxation by assigning the benefit of this income or the actual income to some other source other than where it actually came from. Okay, so these are some rules that kind of go to combat the assignment of income to avoid paying income taxes. So you have first, an individual providing services is required to recognize income received for those services, even though the right may have been assigned to another person. And if property is generated from, or if income is generated from a piece of property, whether that be interest or rent income, the owner of that property is the person who should receive the, or should pay the taxes from that income. Even again, if there's some legally binding document or some reason that the income is assigned to a different person. So basically the logic there is the analogy is income is kind of considered the fruit and the capital is considered the tree, at least in the case of the property, or you could say the labor is considered the tree in the case of services. So the logic dictates that fruit should not or cannot be attributed to a different tree than the one on which it grew. Okay, so again, you'll see this as a common theme as we go throughout the semester and next semester as well, that a lot of tax law, whether it be codified tax law or through case law, pops up or comes up to combat a way that people are avoiding income tax that the IRS or the government, and whichever body, deems inappropriate. So again, we're now looking at the allocation of income between married couples, and how that's allocated kind of depends on the state in which you live. 41 states have common law rules, and under common law, income is taxed to the spouse who earns the income. And obviously, if you're filing jointly, it doesn't really matter who the income is taxed to. But if you're filing separately, that is a big deal. So for these other 9 states in which there's a community property, or in states that are considered community property states, the basic rule is 50% of the income that is generated, whether, for instance, if just the husband works or just the wife works, even though they make 100% of the income is attributed 50-50 to both the earning spouse and the non-earning spouse. Okay, so obviously that will make a big difference if you're filing separately, whether you are considered to have earned 50% of income that your spouse earned or 0% of that income. And even within those 9 community property states, there are different state laws that govern the way that is divided. So for the most part in community property states, any property that's acquired after the marriage, whether that be through income or other ways, is divided 50-50. But generally, any assets that you bring into the marriage can be your specific individual assets and don't get divided between both spouses. So your book uses an example here where there was a case where a husband signs a legally binding agreement to share his income with his spouse. So he basically signs an agreement that says 50% of everything that I make is being assigned to my wife, and she has legal control of that. Okay, and it was found to be a legally binding document, but eventually the court decided that they weren't going to let that go, and so the female, the wife here, was originally the goal was for the husband to have 50% of the earnings attributed to the wife and the wife taxed on those earnings, but eventually the court said no, even though she has the legal right to that money based on this agreement, we're not going to let you do that. But then the reason that I bring this up is that the justification in the community property for allowing community property states to attribute 50% of the earnings to the non-earning spouse, the policy reasons set out for that is that, oh, well, in those states, the non-earning spouse has a legal right to 50% of that income, so it makes sense to tax the non-earning spouse on that income. But it doesn't really agree with the court case that came down that I just talked about, where the husband actually gave a legal right to the other spouse, and even though the court said that the spouse did have a legal right to the money, they were not going to allow the attribution of that income as far as tax law went. So I guess it kind of boils down to where that legal right originated. So if it originated at the state level, where the state law is what granted that legal right to the non-earning partner or non-earning spouse, then the federal government does not want to come in and trump that state law. But if it was, if the right to those earnings was originated in the individual, in other words, the individual signed away his rights or her rights, then the IRS doesn't have a problem coming in and saying, yes, you have to pay tax on that, or no, you don't. So generally, income earned by minor children is taxed to the child, not the parents, and this applies to wages or investment income earned by the child. There is an exception for what's called a kiddie tax, and this is investment income or passive income. Once it gets past a certain level, the IRS says, okay, we basically think you are, that the parent is trying to shift its investment income to the child to get taxed at a lower rate. So once you pass a certain threshold, we're going to say that what's actually happened is the parent is investing this money. So the child is still taxed, but is taxed at the rate of the parent if the kiddie tax law threshold is met. So under the cash method of accounting, and you should know obviously the difference between a cash and accrual method of accounting, but under the cash method, income is generally recognized when actually or constructively received and not necessarily when earned, whether that be in the form of cash, property, or services, and the valuation of non-cash items would be at fair market value. There are some few exceptions to the cash method of accounting, and there are certain instances where the IRS says you cannot use the cash method of accounting, but for the most part, this is the general rule. Now, what does constructive receipt mean? Constructive receipt basically means the taxpayer has the ability to spend money or commit money as a resource. Okay, so if there basically it goes to whether there's any limitations on the income. Okay, so if there's no limitation on the income, then whether or not physical money has changed place or changed hands rather and been received by the taxpayer, whether or not that has occurred, if there's no limitations as to how the income is used, and basically the power of spending that income is in the hands of the recipient, then we're going to say that it's been received. These are just a few exceptions or times where you want to pay attention to the exception of income when the concept of actually or constructively received income being when it is recognized. So you would want to just make a note that Series EE bonds, farming and ranching income, and small taxpayer exception for inventories are instances where an exception to this exists. And again, this is for cash basis taxpayers. So for the accrual basis taxpayers, income is recognized when it's earned, when goods and services have been provided, similar to the accrual method just in basic accounting principles. Earned for tax purposes means all events have occurred to fix the right to receive the income, and of course the amounts of income received can be determined with a level of reasonable accuracy. Now again, under the accrual method, there are also some exceptions that would distinguish accrual method for tax purposes, distinguish that from the accrual method just in general accounting principles. So one of those would be prepaid income. So prepaid income for tax purposes, even if you're an accrual-based taxpayer, is generally recognized when it's received. So that would create a difference between what you are looking at for tax purposes and what you're looking at for GAAP purposes. However, there are, and obviously the tax code likes to complicate things, so there's an exception of prepaid income, and then there's also an exception to that exception. So a taxpayer can defer recognition of prepaid goods if the method of tax accounting is the same method that they use for financial accounting. So basically, accrual is used in both instances. And you're prepaying goods, then you can defer recognition, if someone is prepaying you for goods, and you use for your financial accounting, you use accrual-based accounting, and you are using that for tax purposes as well, then you're allowed to not recognize that prepaid income when it's received. Now, for services, you can defer recognition for prepaid services based on this following schedule here. So you must recognize revenue associated with services provided in year one. So this is, obviously, if the services are prepaid, anything that's provided in year one has to be recognized in that year. Then anything, basically year two just catches everything else. So let's say you prepay, or 5 years of services are prepaid in advance. Year one, you recognize year one services provided in year one. Year two, for tax purposes, you recognize the income that you received that covers services provided in year 2, 3, 4, and 5. So basically, you're still forced to recognize the income before it's actually earned, but it's kind of a compromise there, where you are, for the first year, required obviously to recognize it in the year that it's earned, but then you don't have to that year recognize years 2 through 5. You are basically given a reprieve where you don't have to recognize their prepaid income, except for years 3, 4, and 5 of prepaid income is recognized in year 2. I know that's a little bit overcomplicated, but such is life with the tax code. So these are just various kind of vocabulary items and concepts when we're talking about gross income. You've got compensation, which is just payment for personal services. A business income would be if you're operating any business, and obviously the income would be reported less any cost of goods sold. So obviously you're not paying on just your gross income from business, you're paying on the economic benefit basically that you receive from the business. And then gains from sales of property. Obviously it doesn't make policy sense to make you pay the entire amount that you earn on a property, including what you paid for that property. So it's kind of similar to looking at a property as a business investment, where the cost that you paid to acquire the property is or should not be considered when we look at what's gained from the sale. So you're basically considering anything you paid for the property as a return of your capital in that investment, and then anything above and beyond that is considered income. Obviously, interest is just compensation for use of money. So if someone loans you money, they charge interest for the use of that money until it's paid back. Interest includes interest revenue from corporate bonds, mortgages, life insurance policies, and any type of bank deposit, checking, savings, etc. Anything that's labeled tax-exempt interest, which usually can be boiled down to state bonds, some 501c3 bonds can be issued that are tax-exempt, municipal bonds, and then various types of state or municipal entities. So if you have like a fire district or other state or municipal entity, they can generally be excluded. A Series EE savings bond also has an exception to the recognition of interest, which we'll talk about here. And basically, for EE savings bonds, the interest can be excluded from income just as long as you meet all these criteria. So 24 years or older when purchased, they must be purchased and can't be gifted, though a purchaser can use them for a spouse or a dependent. And the proceeds of the bond must be used for tuition and fees. And when using them for tuition and fees, you have to first reduce the cost of tuition and fees by any exempt scholarships that are not taxed, any veterans benefits, this would be like the GI Bill, and any other type of education credits. And then, of course, if you're married, you have to be married filing jointly. There's also some ceilings whereupon after you pass this ceiling, it starts to phase out the benefit that you can get, the tax-exempt benefit you can get from these bonds, and then is completely phased out when you get to a certain level, as you see here. Okay, so this slide can be used as a basic equation when calculating what all is excluded from EE savings bonds. Generally, rent and royalty income is included in gross income. Security deposits from the point of view of a landlord receiving a security deposit from a tenant, that's not considered a piece of income if it's refundable. If it's a non-refundable deposit, then it is considered to be income. If a tenant or lessee makes improvements to your property, you don't have to consider that income unless those improvements are substituting for rent. So if the tenant says, hey, instead of paying rent this month, I'll paint the exterior of the house, then you would generally say the fair market value of the improvements would be considered taxable there. Dividends are generally included in gross income, and that's why you see the whole issue of double taxation that pops up with C Corps, and why a lot of C Corps will make the S Corp selection to avoid that. We'll talk about the exceptions for corporations receiving dividends from other corporations. We'll talk about that more in the next semester. And rates for individuals for dividends are capped. As far as the company-to-company dividends, the exclusion for depending on ownership amount of one corporation owning another corporation, like I said, we'll talk about this more next semester, but that does not apply to one foreign corporation owning a domestic corporation's stock. I don't have too much more to say about this slide. You can just read that on your own. So let's see. Okay, I lied. This third bullet point I do want to touch on a little bit because it goes into this next slide. So when employee shareholders are determined to either receive unreasonable compensation or benefits, basically what happens is if you are a shareholder and usually a large shareholder of a company that you also work for, it may be within your power to determine what your own income is. So if you have the power to determine your own income, you may be tempted to receive a larger income than what might normally be paid for what you do for that company, so that you don't have to take money out of the company as a dividend. So by so doing, you would only be taxed one time on that income, because it would just be income to you and it would be deductible for the corporation. So from the corporate standpoint, they're getting a deduction on that, and from the individual standpoint, you're not, the money you're getting has not been double taxed. So what the IRS does is basically it will look at the reasonableness of the compensation that employee shareholders are getting, and if you're getting compensation that's like, what you would normally see for your position is like $50,000 a year, and you're getting a $5 million salary, then the IRS will say no. Most of that is actually a constructive dividend, where you're disguising a dividend as just income or salary, so that you don't have to double pay the taxes on there. So if that's disputed by the IRS and the dividend or the constructive dividend treatment that the IRS is saying should happen is upheld, then what happens is the employee shareholder recognizes income, and corporation does not obtain a deduction for the value of the deemed dividend. So basically, the employee, I don't really like how this slide reads. What basically happens is the employee shareholder receives dividend income, which is how this should read, and the corporation is not allowed a normal deduction for salaries, and is instead deemed to have paid out this dividend. So, even though dividends end up being double taxed, that's not quite as bad as it sounds normally, because the maximum rate on these dividends, which are considered capital gains, is 20%. So you can see from this table, if you fit in the 39.6 tax bracket, then your dividends are taxed at a rate of 20%. And if you fit at one of these lower tax brackets, you could be paying 0% on the dividends, or 15%. This is just what a Schedule B looks like, where you would report on your taxes, interest, and ordinary dividends. Okay, so these are the three types of payments that are usually come about because of divorce. You've got child support, a property settlement, and alimony payments. And this is the treatment of those payments for tax purposes. So alimony is deducted by the person paying it, can be deducted as an expense, and the person receiving it has to include it as income. Okay. Property settlement, the person paying the property or giving the property is not able to deduct it, and it's basically not considered a taxable event. So there's no tax deduction on the payor side. There's no inclusion in income on the payee side. And that same thing holds true for child support payments. So obviously, determining that a certain amount is alimony versus child support does have some pretty serious tax implications. To be considered alimony, all of the following criteria have to be met. It has to be paid in cash. It has to be incident to a divorce or separation or other written agreement similar to that. At the death of a payee, the payments have to be stipulated to terminate. It has to be clearly designated as alimony. It can't just be a payment. And it has to be an agreement made between people in separate households. So generally, if this is incident to divorce and it's not considered alimony, it will either fall into the child support or property settlement category, and so it will be a non-taxable event. So these are just some other items and how they relate to income and whether it's included. The face value of insurance proceeds for life insurance is not taxed to the recipients. Generally, discharge of indebtedness is usually of a loan, but any indebtedness generally is considered taxable income unless there is some specific exclusion. So if your student loan debt is discharged right now, and that's generally considered taxable income to you. Pass-through income is just dependent on the tax status of the person receiving that income. So, obviously pass-through income just means that the entity itself is not taxed. The recipient of that income, the income is taxed as if it's normal income to that person. So it just depends on what's applicable to that individual taxpayer at that point. Generally, prizes, awards, lottery, gambling, all considered taxable income. Any type of illegal income is considered taxable. In fact, that's how a lot of big-time, organized criminals end up being arrested. Like Al Capone was arrested for tax evasion, not for any of his other illicit activities. So basically, this falls under the category of, if it's not specifically excluded, then it has to be reported as income. And unemployment compensation does create taxable income, although that is a change that has happened over time, because originally unemployment income was not considered taxable income. Calculating taxable Social Security income is somewhat difficult, but using this flow chart, it can be made considerably easier, because you just have to go through this flow chart and follow the yes or no's here. So I would keep that available as a reference tool. Generally, insurance proceeds that are not life insurance and court awards are taxable to some extent. This includes insurance proceeds for lost profits. If property is destroyed and you get insurance from that, whatever basis you had in the property is excluded. So this allows you basically to get back what your basis was without having to pay taxes on it. Also, there are some exceptions allowed where if there's involuntary conversion, and this basically means you are being compensated for a piece of property for whatever reason that you did not want to sell. So this could be it's destroyed in a fire or whatnot, but then you want to, instead of taking a cash payment, you want to take the cash and reinvest that in a similar property. You don't even have to worry necessarily about the basis, because you're going to reinvest in similar property. So there's a specific exclusion under Section 1033 that allows you to do that within a certain time frame. But that's just something to keep in mind and reference if that situation arises. Court awards are generally taxable, with major exceptions coming from payments because of physical injuries or sickness. Okay, so if you wrongly deduct something one year that's based on some type of estimate, so you see the example here, and then you find out, after you've already made that deduction that it was wrong, the next year or whatever, this basically is just saying that if you make a good faith mistake because of one of these types of estimates that you later discover the next year you're basically going to make up for that. So this claim of right concept basically applies to situations like the receipt of a judgment that's paid from a lawsuit or something, where someone pays you this judgment, but they've also appealed the case, and you may or may not be able to keep that money. You are taxed on that money when it's received, but then if later on appeal or whatever it's found that you don't get to keep that money and you have to pay it back, then similar to the last slide we looked at, you are allowed to deduct that amount from income in the year that you have to pay that back. And if it ends up being a large amount, the refund ends up being more than $3,000, then you're allowed to reduce your current tax by the actual tax paid on the refund. So this is basically, let's say that you were taxed 3 years ago an amount that you now have to pay back. If you ended up paying more tax in the year that you paid it, then you would save by reducing your income this year. You're allowed to reduce your tax liability by the amount that basically cost you in tax liability the year that it happened. So it's essentially guaranteeing that you're going to be made whole eventually if you're wrongly taxed on an amount that you don't get to keep. But it's also saying that you are immediately taxed on that amount. And finally, these are just a few of the areas, considering what we've talked about in this lecture, that may be ripe for tweaking in order to do work as a tax planner. Deferred compensation arrangements, shifting income, like within family members, can be a lucrative way to save on taxes. Planning the bonds that you invest in based on taxable versus tax-exempt interest, the way that you agree to receive prepaid income or don't agree to it, how alimony is structured, and the possible investment in Series EE bonds.